There are ways where we can reduce our taxes. In other words, do tax planning to look ahead to protect our behind from the tax man. Now, let's go through a couple of the strategies that you found very successful here the last 5 or 10 years.
Let's say your income's high, right? Your income's $1 million, $2 million, whatever the number is, and you're in a place where you're saying, okay, gosh, I don't want to buy more trucks. I don't want to buy more vehicles. I don't want to buy more commercial property. What can I do? There's a ruling actually in section 170H of the IRS code. What it allows people to do is essentially participate in the ability to preserve ground. And by doing that, they get a tax deduction. Now, many of these deals, Coach, as you know, will bring a 3, 4, 5. There's some current deals right now that are open that actually provides a 5-to-1 deduction. Now, here's what that means. So for every dollar that you put in, you get a $5 ordinary income deduction. And that's using what's called a best use value that the IRS allows. And so, Coach, really what it is in simple format, if somebody has an income of, let's say, $2 million, we can literally reduce that income by half. Unfortunately, the bad news is the IRS won't allow us to cut your income more than half. But we can reduce the income by half, cut it down to $1 million. And in that scenario, it would technically save $370,000 in ordinary income taxes just on the federal side. Now, if they have state taxes, then obviously that would be an additional tax savings as well. So let's say you're at 37 federal plus 7, which is 43 or 44. Right. So now you're going to save on that $1 million. Your real tax savings is $440,000 saved. And how it flows through to the investor, Coach, and this is the best part about it, you don't have all of these things that, like if you buy a building for a deduction, now you own property, you got property taxes, you got insurance, you got maybe all of these other moving parts. With this deal, it really just flows through. It's Form 8283, which is a non-cash charitable deduction. It must be done in the current year. Again, it's part of the IRS code, section 170H. A lot of CPAs are in a place where they may not be aware of it. So it's going to cost you $200,000 to put in the deal, the investment. And ultimately, what that's going to get you is a $400,000 tax saving. Basically, here's your bottom line. If you don't do any strategy, you're going to give $400,000 to the government, and they're going to like you for it.
No, they're not.
If you do exactly. If you do strategy, you put $200,000 in the deal, and you save $400,000 in taxes. So you basically double your money year one.
And then what happens to the money that you put in? What eventually happens to that money?
Let's just say somebody put $200,000 into the deal to get $1 million deduction and roughly $400,000 of actual tax savings. Well, that $200,000, about 10 to 15% of the monies, Coach, is going to go into a separate structure that's going to kick anywhere between 5 to 7% a year on that $200,000 back. And then once the ground is sold, after it's satisfied all the conservatory mechanisms and requirements, in about 4, 5, 6 years-ish, they're roughly going to get some more monies back as well. So you're going to get, over the course of a 5 or 6 year period, Coach, as you know, anywhere between 20 to 30, roughly all in back percent of what you put in. So if you put in $200,000, you should expect to see somewhere in the ballpark of $60,000 come back to you over the course collectively of about 6 years.
And really, it's a win-win-win to me. It makes a lot of sense.